Rolling. Firstly, thank you everyone for joining us here today. As people continue to join us, I will add them into our room here today. I want to say that we definitely understand that the business world is ever changing and taxes are always there, and we're wanting to stay ahead and get you the information as things are becoming readily available. That's why we brought in this webinar talking about SB 5814, which is causing a lot of attention and wildfire for businesses and marketing agencies and a whole plethora of sectors and the cost of doing business. So I'm not an expert in this field, but we definitely have people in our valley that are here to help all of us and to help you. So I'm going to hand it over to Aaron Wilbur to give us a little information on who they are as a company.
All right. Good morning, everybody. That's fun seeing some familiar faces pop up on the participant list. So thanks for joining us, and thanks, Teddy, for allowing us to give this presentation. We have certainly been getting a lot of questions as well on these areas of concern for taxes, and then opportunities also. So we definitely wanted to spend some time today hitting on the opportunities as well. So with no further ado, I'm just going to start by, hopefully everybody can see the screen I'm sharing. If you not, give me some thumbs down or something like that in the chat. But we're Larson Gross. So I'm Erin Wilbur, and Shelley English is also going to be participating to a large degree. She's going to be sharing the parts of the presentation that you're probably the most interested in hearing about. So we're Larson Gross, and we are a full service public accounting firm, and we are located in Wenatchee, so as well as a few other places around Washington State. So just a little teeny tiny bit about our firm. We've been in the Wenatchee Valley, previously Homechick Smith and Associates, now as Larson Gross for pretty close to 90 years. And Larson Gross as a firm is headquartered in Bellingham, started in Linden about as many years ago as that. So long time firm, really purposeful to be in smaller communities like Wenatchee, where we love to live and serve our clients. As I said, I'm going to be doing a little bit of the presentation, but really the bulk today of the presentation is going to be from Shelley English. She is a long time bookkeeper and accountant in the Wenatchee Valley, and we're lucky enough to have had her join our team a little over a year ago, I believe. And so Shelley is an expert in our actual firm expert. So here, headquartered right in Wenatchee, we've got our firm expert in the Department of Revenue Matters with Washington State. So we're going to kick off the presentation for you guys with that topic. So sales tax changes are on the horizon and have already actually kicked in, as everybody I think is fully aware. So I'm going to hand this over to Shelley to start us off talking about sales tax. We're going to go into talking a little bit then about the One Big Beautiful Bill Act, which had incorporated within it some income tax components and also some payroll tax components. So I'll quickly go over the income tax. Shelley then will round us out with the payroll tax. So the way we kind of thought that we would structure this for you all is chunking it up in about a third. And because we're going to be jumping around in concepts after we talk about each area, we'll just open it up for a quick 5 minutes or so of Q&A. If you guys have anything on that topic that's like a burning question in your mind, we'll try to address it before we move on to the next topic. And then, of course, if there's anything that we don't get to, just to make sure that we have time to get to everything on our agenda, we can have a little bit more time, I think, at the end for some additional questions that might come up. So with no further ado, Shelley, go ahead and kick us off. Sales tax.
All right. You're not sharing anymore, Erin. Are you going to?
I'm not? Oh, thank you for
No.
telling me. Good
You're
grief.
welcome.
Okay, let me try again. There you go. Can you see it now?
Yes, ma'am.
Okay, tell me if it goes away again.
All right. I will.
Teamwork.
Hey, welcome everybody. Thanks for coming. My name is Shelley English. I've been with Larson Gross for about a year and a half. I support the tax department and our business compliance and advisory practice area, doing all kinds of things, everything from software conversions to payroll setups, all kinds of things. And so today we're going to talk about the fun topic of the new DOR tax rates and the new sales tax on some services that were previously only subject to the service tax. So we didn't have to collect sales tax on, we didn't have to remit sales tax, but the ESSB 5814 changed all that for some services. So I'm just going to kind of quickly go down over these. Some things we can address, other things um, we, without knowing specific details about your business, we could not address directly here. But we're going to provide contact information and everything at the end if you wanted to make an appointment and get more information. So the big one is the expansion of services subject to retail sales tax. We added things like advertising, IT, software to taxable retail sales. Some other services are like temporary staffing, which is another one that people in our area are having some issues with. So this little chart just kind of talks about the effective dates and the changes. So the new services subject to retail sales tax, instead of reporting them in the B&O services classification, they'll be reported in the retailing classification, which is actually a lower rate, but it requires that you now collect and remit sales tax. And so if you are a purchaser of these services, advertising services, the ones that are included, IT, if you have a company that does help desk stuff for you or that you outsource your IT, there's more sales tax you're going to have to start paying. And we'll get into some of those in just a little bit. So another thing that just changed is tiered B&O rate increases for actual services. The rates are now based on gross income. You can see on the chart there, between or less than $1 million is 1.5%, $1 million to $5 million. And remember, this is your gross receipts. Doesn't include any deductions or anything. It's your gross income from all sources that are subject to the tax. So we have that tiered rate. And there's also going to be a new surcharge on high grossing businesses. So you get that 0.5% if your taxable income exceeds $250 million a year. That doesn't start until tax year 2026. So when you file, if you fall into this category, when you file your first return for January 26, and then that surcharge is going to be on there. And can we go to the next slide, Erin? Thank you. Okay, so advertising services. This one's kind of interesting because it does have some exclusions. Web hosting, the company that you pay to host your website, that's still going to be considered a service. Domain registration, you don't have to pay sales tax on that. Certain in-print advertising, like magazine advertising, radio and TV ads, fixed signage, those are not included. So what is included is the design, the campaign planning, placement, lead generation, and acquisition of advertising space. So if you hire somebody to do a digital ad campaign for your business, that's going to fall into this one. IT services, help desk services, network training, IT consulting, data processing. That one's kind of vague, and it's getting some interesting questions coming up on that one. Data entry, network operations and support. Those are now subject to sales tax. So if you have an IT business and you provide any of these services, you need to start collecting sales tax as of October 1st of this year. Excluded, again, web hosting, domain registration, payment processing services, the merchant services accounts that you use to take credit cards and they charge you fees for that, still not subject to retail sales tax. Custom website development services. This is another new one. Website design, development, and support provided by a developer to a customer. So if you're using some kind of canned software to create your own website, that's not included. If you hire someone to develop your website and provide support to it, they need to start charging you sales tax. Or if you provide those services, you need to start collecting and remitting sales tax. Again, web hosting and domain registration services are excluded. Live presentations. This one had a lot of questions when it first came out, and there has been some extra guidance released on this. In person or internet, real-time interactions, workshops, webinars, courses with participant instructor interactions. So basically, if your business hires someone to come from outside to give a presentation to your employees on a particular topic, that company needs to charge you sales tax. If it's a webinar, if it's over the web, and there still has to be sales tax charged. Now, the fun part about that is we have the source-based sales tax rules, right? So you have to charge sales tax based on the location that's receiving the benefit. Well, if you've got a webinar, you could have people from all over the country that are participating in this. And so there are some specific details about where to charge the sales tax, how to determine the location of the sale. And that's something that we don't have time for today to get all into. And again, it's one of those things that we would need to know more details about exactly what you're doing before we can answer any specific questions. So just keep that in mind. If you are purchasing these items from other companies or if that's what you're selling. Classes at accredited schools and universities, tutoring is not included. So, if you take your kiddo down to one of the tutoring places in town, that's not considered a live presentation. And also, this is one that we had with one of our clients, which is one-on-one consultation is also excluded. The client provides consulting services to businesses, but it's not considered a live presentation because it's just one-on-one consulting. And the next slide, please. So we got some more going on. So investigation, you hire a private investigator. They have to charge sales tax. If you are a private investigator, you need to collect and remit sales tax. Security services that you might hire to check on your business is now taxable. Locksmith services are specifically excluded. I'm not sure why that one's taken out, but it is. And then here's another one that has been big because we have a lot of ag people. A lot of ag businesses might hire a third-party company to provide them with labor. Is that considered temporary staffing? Well, maybe. It depends. The way I've been kind of looking at this is who is going to give the employee their W-2? If it's the business that's hiring them, then it's considered a direct hire and it's not considered temporary staffing. If it is the company that provides the employee, if they're paying the employee and eventually providing their W-2, and then that is considered temporary staffing, or whether it's like one of the temporary staffing agencies in town, they pay the employee themselves. So that service that they charge the business for is now subject to retail sales tax. Hospital staffing is not included, specifically excluded. They do a lot of, temp nurse hiring, specifically excluded. Direct hires, again, that goes back to who is going to provide the W-2, who is paying the employee. If you're the business and you have H-2A people, you're paying those people. So even if somebody acts as, a headhunter for you and goes out and finds the H-2A people, you're paying those people. So it's not considered direct staffing, or it's considered direct hire. So whatever you're paying that headhunter is not subject to retail sales tax, which is that third-party outsourcing note on there. Independent contractors, that opens up a whole other can of worms regarding who is actually an independent contractor and who should be an employee. But if you have an actual bona fide independent contractor, then they do not, providing a service, then they do not have to charge you sales tax. The custom software and software customization, if you try to read the guidance, it seems super duper complicated, and it's really not. Um, Sale or right of use of custom software intended for use by one entity or person, or the customization of pre-written software. So if you hire somebody to write a program specifically for your business, and your business is going to be the only business that uses that software, then it's considered custom software and it's subject to retail sales tax. If you hire somebody to customize some pre-written software that you already have, and you say, hey, I wanted to do this instead of that, and it's only done for your business, then that service is subject to retail sales tax. If you have a software subscription, like we have a client here who has software that people can subscribe to, it's kind of like an HR feedback software. Because it's a subscription software, multiple people are using it, then that is not subject to the retail sales tax. Just remember that if it's custom software just for you, then it's taxable. Or if you're writing the software just intended for one person or entity, then it's subject to retail sales tax. Digital automated services. This is another one that gets pretty weedy. It removes several former exclusions that were under digital automated services, like the live presentations we discussed earlier that used to be okay if it was online. It's considered digital automated services, and so it's not subject to sales tax. Digital advertising is another one of those that was previously not subject to sales tax, but it is now. And excluded from that is telehealth, telemedicine, and services such as that are specifically excluded. So this is just kind of a rundown of the things that you might run into. And so next slide, please. Everybody's going to get a copy of this presentation, and so we provided some links in it. Larson Gross on our little thought leadership page on our website has a great article from our state and local tax leader, Janae, on the insights for temp staffing for ag employers. It just kind of goes over a little bit in more detail what I talked about today. We have linked all of the DOR interim guidance statements, and then in there is the final guidance. Whenever they come out with something, they'll post their guidance. There's a bunch of these just because there were so many questions at the beginning of this when it was all released in July. I also provided a link to detailed guidance on sourcing rules, where the sales tax needs to be charged. Current contracts. What if you have a current contract with a service provider that doesn't include sales tax, right? You weren't expecting to pay that. And so there's some guidance in there on what constitutes a current contract. There's an extension to where you don't have to start collecting or paying sales tax if you have a current contract. And then there is the MPU, or multiple points of use exemption. And that is very weedy. It has to do with, cascading rules and how to determine what the source of the sale is. And again, that's one of those really detailed things that we couldn't get into without knowing more details of your business and what you do. On this page is also a link to IRS penalty relief for employers on the tips and overtime reporting, which we are going to get into a little bit later. So does anybody have any direct questions? I know we kind of went through this rather quickly, but happy to try to answer any questions for you. You can raise your hand or drop it in the chat.
I'm going to give the uncomfortable silence that sometimes people need to chime in with a question. But if there aren't any, that's okay too. We realize that's a lot of information. All right. That's probably long enough for that. Thanks, Shelley.
Thank you.
Yeah. Okay, so we're going to roll next into the more on the federal level then of the One Big Beautiful Bill Act and what that means for small businesses. So I mentioned earlier that there is a income tax. Well, I think most everybody probably heard about the One Big Beautiful Bill. OBA is what we're calling it here lovingly in the accounting profession. It was on the news quite a lot, and there was a lot of publicity around getting it passed. And so I don't think that it is necessarily new news for anybody, but wanted to point out a few key insights. And hopefully then as we're moving towards the end of the year, some things to think about in terms of potentially tax planning, business planning, just things that we thought would be good for small businesses to have in mind. So why does this OBA, why does OBA matter to small businesses? So it was signed into law earlier this year, and it really is one of the most significant tax and spending spending reforms since about 8 years ago. So in the tax world, there was a lot of things baked into this tax related, but it's actually was a very broad piece of legislation that the Farm Bill was baked into it. As an example, a lot of things that impact USDA and FSA and our local farmers were baked into this One Big Beautiful Bill. So there was a tax element, and on the tax side specific to businesses, really, it was not a game changer, I wouldn't say, but what it did was provide us with a lot of clarity on things that were prior to the act unclear. So a lot of the things in the 2017 Tax Cuts and Jobs Act were written to sunset. So there was an ending point. And so the unknown for all of us in accounting and anybody that is doing any tax planning for their business was what is it going to look like going forward? So this act gave us a lot of clarity around that. So in that vein, definitely not just for the big guys, definitely small businesses need to be aware of what's happening in here. And I would say for the most part, it is opportunities. So that's also great too, when we're able to talk about things in that context. So a couple big things. I'm just going to hit on a couple of big things. There's a lot of small nuanced things baked into the One Big Beautiful Bill that aren't going to be relevant to the majority of companies out there. So I'm just hitting on the big ones. I would definitely encourage everybody to if there's something that you feel like you need to move on or might benefit you for your tax planning purposes for your business, talk to your accounting professional. Get some guidance on all of these things. I'm gonna hit them at a real high level. So the big thing that we in the tax planning world are very pleased to know is that the One Big Beautiful Bill did reinstate and make permanent bonus depreciation. So bonus depreciation is an accelerated deduction for capital assets. So assets that you buy as a business that are going to benefit you beyond 1 year. And we have had bonus depreciation, so the ability to write those costs off in the year of purchase, even though the benefit to your business extends beyond 1 year. We've had that as a tool for quite a while. But what was happening is it was formally 100%, and prior to that, there were some other rules that made it a little bit more complicated. But for a while, it was pretty simple. You got to write it all off, and then over a series of years, the 100% became 80, became 60, and was then going to become 40%. And this bill reinstated it back to 100% and made that 100% permanent. So it will be 100% until some future tax bill changes that, which I have no doubt will occur. But for now, we know that we've got 100%. So you have the ability to elect out of that as a business, but the tool is always in your tool chest to do the default, which is to take the 100% write-off. The interesting thing to think about Also, in terms of this bill, is the date. So January 19th, 2025. It applies to property acquired after that date. The relevance of that date is the next day. January 20th was when the new presidential administration came in. So we've got like a little weird, I don't know, a little bit less, like 2.5 week period of time at the beginning of the year, that if you bought assets during that period, the 100% is not in play. But as long as it was after the 19th, it is. And the other thing that the One Big Beautiful Bill Act did was also expanded 179 limits, which is really just, it's a code section that gives us another way of writing off assets in the first year if bonus depreciation doesn't work out for the particular type of asset that you're talking about. You can always pick and choose between the two, and the way I think about the difference is bonus is like, it's 179 is like fine tuning. You can really pick and choose and be a lot more precise about what you're writing off. You don't have to write off the whole asset if you don't want to. You can really get your taxable income down to what you need it to be specifically. Bonus depreciation is more like, we're burning it down kind of approach. We're taking the whole thing. So both of those tools are in the tool chest. And so as you are coming down to the end of the year, just keep that in mind and know that you've got a lot of flexibility around writing off capital asset purchases. And also, we have this new concept now of qualified production property. This is going to be applicable for some, but probably not for most. And it relates to real property, construction or acquisition, as long as it's within a certain period of time and the requisite date. So this is temporary, it's not permanent. So if you're constructing or building a piece of real estate that is used in the manufacture of tangible property, so the manufacture of property domestically, so this is a domestically driven bill or law, then you get to write off real estate much more rapidly than would ordinarily be the case. Usually it's 39 years for real estate used in a business. And in this case, if you meet the parameters, then you might get to write off the building, that is the part of the building that is related to the manufacturing, right away. So this, under the right set of facts and circumstances, could be a really great tool. Just keep in mind the dates, and a couple of examples we've got. I'm not going to go over them right now, but you can refer back to them once you've got access to the slides. Just the difference between if you're building the building and how you might want to think about this deduction versus on the next slide, if you are, the first one was buying it actually. This one is if you're building the building. Buildings under this provision could potentially qualify for bonus, which is generally not the case. Just keep in mind it's temporary. So if this applies to you, it's pretty niche, kind of little specific area, but if it applies to you, just keep in mind the time frame and when you would need to be thinking about beginning and completing construction to qualify for this. And then also the One Big Beautiful Bill Act let us know that a nice deduction for business owners that was potentially going to sunset is going to continue on. So this is great news. This would have been a big deal if it had gone away. It's something that business owners of pass-through entities, partnerships, S corporations, LLCs, but not C corporations, that they qualify for to bring down the effective tax rate that they pay. So at kind of a very basic level, it's generally going to be a 20% tax deduction that you get on your profits of your small business. And this shows up on the ultimate individual tax return of the business owner. So we're in a bracketed tax system. The top tax bracket for individuals is much higher than the flat tax rate that applies to C corporations. So this was a tool that came about in the 2017 Act to kind of close that gap of make it more tax beneficial for small businesses, which are generally our flow-through entities, and bridge that gap of what the tax that they are paying in comparison to typically larger businesses, which are C corporations. So this was something that specifically was geared and aimed at helping small businesses. And it essentially brings down the top tax bracket for individuals that have this type of a deduction, all the way from 39% all the way down to 29.6%. And so it really helps a lot. It's a great deduction, and we're really glad that it's continuing on. They've extended some of the ranges. I guess a thing to keep in mind is if your income is too high, or you have what's called a specified service trader business. So accounting firms are in this, service businesses like attorneys, consultants, healthcare. They have special rules. And so it makes it a little bit harder to qualify for as beneficial of a deduction. But it's still definitely possible. And there's some planning that you can do within all of that for your business in terms of wage structuring for owners and capital asset acquisitions. So it's a very nice deduction. We've got some phase out ranges that were made, that were broadened and expanded so that more people will qualify for a better deduction going forward. And then these ranges are going to be adjusted for inflation after 2026. So it's a great deduction. You'll want to make sure that you're getting it. I've got an example here that really gets pretty specific. So I think I'm going to, at the end of this, open it up for some questions in case anybody has any, but I'll leave the specific example for you guys to digest once you get your copy of the slide deck. This here is just like an illustrative example of what I was describing before and how this deduction is bridging the gap between small businesses that are structured as flow-through entities, which is in fact how most small businesses are structured, compared to C corporations. And so a C corporation gets a flat tax rate of 21%. So that sounds pretty good, especially in comparison to the individual top tax bracket, which is significantly higher than that. Except the other thing that C corporations get is a element of double taxation. So the profits are taxed within the C corporation at that flat low rate of 21%. But then if the business owners would like to have that profit in their pocket, as most business owners would desire, there's an additional tax to get that profit out of the corporation because it comes out as a taxable dividend. And that could be as high as 23.8% and as low as 15%. There will always be that second layer of tax to get your profits out. So the 21 plus the 15 plus potentially a little bit more, depending on your level of income, pretty quickly gets you up above what your effective rate of tax would actually be as an individual. So this slide and the two after it are just to kind of show how this qualified business income deduction really helps with that. So this is really interesting math if you're interested in math and accounting, but really just an illustration of the concept that was being described there. So another thing that OBA did was it brought in much earlier expiration dates for a number of the clean energy credits and deductions that we have been enjoying than was previously expected. So the expiration date of these credits and deductions were in some cases, something that was permanent is now going to expire at the end of or the middle of next year. And in other cases, we have already seen an expiration of some of these credits. So the EV vehicle, the credit for purchasing an EV vehicle, for instance, that is already gone by the wayside. So there's no more credit there. The next credit on the list, the new energy efficient home credit, that is really something geared highly towards the construction industry, and that will be expiring sooner than expected, as will a number of others, probably that don't apply to all too many people on this presentation. So the main key takeaway here, and it's highlighted here in more detail on this next slide, is that you don't have as long as you thought you did to take advantage of these credits if they are credits that you were in fact taking advantage of. So just be aware of that. And I guess if there's any questions, I'd be happy to take some. And if not, then I'm going to turn it back over to Shelley to talk about the payroll tax aspects of the One Big Beautiful Bill Act, and then take us to the finish line. I guess one thing to mention too, if there, I know, no, I don't love to raise my hand in a setting like this and ask a question, but if you do have any, don't hesitate to email either Shelley or I, and we'll be happy to provide you more information if that's readily available at our fingertips, or kind of talk you through your next best steps in addressing these questions. All right, Shelley, I'm gonna let you take us home.
All right, thanks, Erin. So as I'm looking through this, I just realized that I deleted some important words in my next slide, and so I'll talk about that when I get there. And I'm just trying to do the old "was my face red" situation. So we're going to talk about flexible spending account increases. It's not really payroll tax, but it's usually, it's a payroll deduction, so we kind of put it in there. Same with the 1099, NEC and miscellaneous threshold increase that begins in 26. There's an additional paid leave credit that's going to be available to Washington employers. And then we're going to get into the fun of the tips and overtime, and talk about some of the misconceptions and what it really means. Next slide, please. So this is where I made the mistake. The FSA annual limit, that $7,500 is the dependent care FSA. I accidentally deleted those words at some point. So that right there in the slide is only for dependent care FSA. So if you have one that helps pay for your child care, that's going to be for you. The healthcare FSA regular is only going up $100 to $3,400. And that begins in 26 also. So the paid leave credit, there's been a paid leave credit since COVID for employers who provide paid leave programs to their employees and pay for them. Here in Washington State, we have a mandatory paid family medical leave. And so because the employer doesn't pay for that for the employee, they're not paying those wages, there wasn't a credit for us. But now there's a new credit for the employers who pay for the paid leave that is in conjunction with the federal Family Medical Leave Act, which requires that insurance premiums be paid while the person is on the federal Leave Act. So for the 90 days, if they're out for the 90 days, you have to keep paying for their insurance. The credit gave the employers who, again, had their own internal paid leave program to be able to take a credit for part of those insurance premiums that they paid while their employees were not working and contributing to them. Now, here in Washington, we have mandatory paid family medical leave. And again, we also have to go by the rules of the federal laws and keep those insurance benefits active while they're gone. So there's now a credit that we can take here in Washington for any insurance premiums for wages in some cases. The criteria isn't quite spelled out very well yet. But again, that's something that could be changing any minute. But anyway, there's a credit for you to take for those premiums. The 1099s, we do our 1099s. It's been that $600. If you pay someone $600 for legal services or, non-wage compensation, then that would mean that you would have to provide them with a 1099 at the end of the year. Effective 1/1/26, that threshold increases to $2,000. So when you create your 1099s for 25, you're still going to use that $600 threshold. But when we do them in 27 for 26, you don't have to send them to anybody that you paid less than $2,000. So that should decrease a lot of the 1099s that you have to send out and that you're going to receive if you do that kind of work. So here's the fun part. No tax on overtime, no tax on tips. And I'm sure a lot of employers are already getting questions about this from their people, especially employers that have businesses that have tipped employees, customarily tipped employees. And so we're just going to kind of, even though this is more of an employee issue, and with the new guidance and the guidance relief, the thing that employers have to do right now is nothing. However, you're going to get questions. I do not recommend that employers give their employees tax advice. But what you can do is when they have these questions, you can say, contact a tax professional or maybe, anybody who assists them with their tax return, because that's really where the impact is going to be on this one. Next slide, please. So overtime deduction. Your employees might say, great, I don't have to pay tax on the overtime anymore. Well, that's only partially true. The overtime deduction, which is retro to 1/1/25, only applies to the overtime premium, which is the 1/2 part of the time and a half. So if you pay somebody $20 an hour, their overtime rate is $30 an hour, they only get to take the deduction on the $10 an hour, not the whole $30 an hour. There is no change on how overtime will be treated on payrolls. You're not going to have to change anything on your payroll system. You're not going to have to stop charging overtime or charging tax on the overtime premium. It's going to be a deduction that the employee takes on their tax return. The overtime is still subject to all FICA taxes, Social Security and Medicare. That's not affected by this deduction for the employees. So just kind of remember it's the premium. So what about tips? Oh, yay, I don't have to pay taxes on all of my tips anymore. Well, that's not true. Qualified tips are voluntary tips. So tips on mandatory gratuities for large parties, service charge on, say, a banquet. It doesn't matter what you call it. If you call it a service charge, if you call it a mandatory gratuity, if it's distributed to the employee, those are still subject to federal income tax. And so there's no change, again, on how tips will be treated on payrolls. They take the deduction on their tax returns, and it will not affect the employer's FICA tip credit. So if you have employees that get tips, you get a tip credit for the FICA taxes that you paid, the employer portion paid on those tips, and this doesn't affect that at all. Next slide, please. So what's next? Some states that have an income tax, Washington is not one, but if you have employees in multi-states, some states are adjusting their regulations to say, okay, you can also deduct your overtime premium and deduct taxes on voluntary tips on your state tax return. Thankfully, as a former payroll person of many, many years, I know there were a lot of payroll heart attacks going on when these rules came out. How are we going to get our software updated? What do we have to do? Who's going to change the W-2 form? What's going to happen? Well, somebody at the IRS finally figured out that that's just not something that can happen before we have to do our reporting for our 2025 payrolls. So the IRS is providing transition relief, meaning there will be no penalties if you don't have the tips and the overtime premium pulled out on your W-2s. So basically what the new W-2 is going to have to look like, it's going to have to say Here's your wages. Here's the portion of the wages that's overtime premium. Here's the portion of the wages that is voluntary tips. And to make it even more fun, you're also going to have, I don't know how many people here are familiar with SOC codes. If you do file payroll returns, you know that they've been added to unemployment returns for the last few years. An SOC code is a standard occupational code, which is basically assigned to a particular kind of job for data gathering, for reporting on employment matters, that says, okay, this person, their code is XYZ. And so that means that they're a server in a restaurant. Okay, those codes are going to have to be on the W-2s because in order to get that tip deduction, you're going to have to be on the list of customarily and regularly tipped employees who are eligible for the deduction. The list was released in September. There is a PDF, and I was kind of reviewing it again today, and some of the occupations on there make total sense, of course, and some of the other ones I was a little confused about, like I didn't know you're supposed to tip your electrician or the guy who installs your HVAC or your new plumbing system in your house, but those are on the list of regularly and customarily tipped employees. So I guess we've all been chintzy because I've never tipped one. I don't know about you, but maybe we should start. So that's pretty much it for now. Again, one of the things is I do not recommend that employers provide tax advice to their employees. That was my people would ask me questions, what should I claim on my W-4, things like that. And, the payroll department does not dispense tax advice and would invite them to visit with a tax professional or something like that. But I know you guys are getting a lot of questions. Just don't take it upon yourself to tell them what to do on their personal tax returns or what to claim on their W-4s. That could be an issue that's coming up. Well, if I don't have to pay tax on overtime, should I change my W-4? Again, I don't recommend an employer giving that kind of advice to their employees because it really can come back and bite you. So it's best to just advise them to consult with a tax professional, do some research, and take care of that on their own. So anybody has any questions, I'm happy to entertain them.
That's really good advice, Shelley, there at the end. Be careful. Be careful to be the answer when you shouldn't be. I have a question for you on the well, either one. You go ahead and tackle it of either topic that you feel like would be the most useful to the audience here. But what is either in the Department of Revenue changes or the payroll tax changes, what is the most common question that you are fielding, that you are hearing coming up from clients and folks that are business owners that are working through all of this, employers? What are you hearing come up the most?
On the payroll side, as soon as all the news was released about all of this, I got calls from some clients. How do we do this? How do we change our W-2s? So that's a big concern. Thankfully, we don't have to worry about that for this year. It's going to be up to our software providers really to adjust that and figure out how we're going to break out, the overtime premium and the tips and everything on the reporting. I think that's probably been the biggest question. But thankfully now with the new guidance, the answer to that is you have to do nothing this year. So you're not going to get in trouble for it if you don't have that separated on your W-2s, and literally nobody is. So, it's not just you and it's going to be okay. As far as the sales tax goes, it's the increase in the B&O tax and people wanting to know how that's going to affect them. And then the sales tax on services. And also the most complicated one is the multiple points of use exemption and the sourcing rules. If I put on a webinar and I've got people in 5 different states that all work for me that are on the webinar, where is the sales tax coming from? How do we charge sales tax on that? So it's those 2 things I think that I've been getting the most questions about. And our state and local tax team in general has been getting the most questions about.
Yeah. It's a lot for business owners to try to figure out how to incorporate into their, well, first of all, get a general level of understanding, and then and then figure out like, what does this mean for me, and how do I incorporate this into my pricing structure and my budgeting and
Right.
mhm,
Yeah. I mean,
softwares
if
and
you do a
yeah.
lot of digital advertising, we had a meeting, and the client bought a lot of digital advertising, and they were going to have to end up paying tens of thousands of dollars in sales tax on that advertising now that they didn't have to before.
Mhm.
So that's something that you're really going to want to look at to make sure that you get that in your budget, in your tax plans, just make space for it because it's going to happen. And it should be already happening now because it went into effect on October 1st. And so if you sell those items when you filed your October excise tax return, it's going to be there. And the new rules are going to have to be followed. So it's been that, just mostly the sales tax and the overtime and tips.
Thank you for addressing that
Thank
question
you.
for me. Yeah. Teddy, I think we're wrapped up here. So I don't know if you want to close us out, or I guess I would just say, yeah, we're very happy to support the chamber, and glad to be able to give out this information to those of you in attendance. And we'll make sure that Teddy has a copy of the slides. I know that was a question in the chat. So yeah, everything that we shared up today, you'll have at your fingertips as well.
Yeah, thank you so much to Aaron and Shelley for giving this great presentation. I know that I'm no tax expert in myself, so that's why we bring the tax experts and industry experts to you. Like she mentioned, we'll get the slide deck sent out to you all, as well as there will be a video link that you can always reference this video, as well as some contact information to Aaron and Shelley, who are local here in Wenatchee, for your questions. Other than that, I want to say thank you all for joining us here today, and I'll give you 6 minutes back of your day and hopefully see you at an event sometime soon. Thank you.
Thank you.
Teddy, thanks everybody. Have a great day.
Thanks.